Now, UnitedHealth Group is a diversified healthcare company that provides health insurance as well as services through their two main divisions, and they offer insurance coverage as well as solutions and technology in this sector. But what we want to highlight is essentially the overall market hasn't been that great over the last day, but in particular, healthcare plan companies like UnitedHealth have had a pretty poor last 30 days. In fact, they themselves are down 15% alongside the likes of CI, ELV, CVS, just to name a few. Now, when we look at this company itself, over the last 5 days alone, it's down 5%. Just today, down 2.61%. And if we look in 2024, they're pretty much looking very poor, negative 1.3. Now, is today a great opportunity to exploit this company's poor performance, given that the fundamentals do look strong, something that Wall Street agree with their strong buy rating, Seeking Alpha also giving this a buy. However, we do know Quant have given this a hold. Now, we're going to get to our answer in today's episode. It is one that we hold in our own portfolio, so we'll be giving you our thoughts as we go along in today's session. But we want to highlight two analysts here. Now, we won't run through the videos, something you can listen to, but we can see top analysts are saying right now it is hard to bet against this company, given the fundamentals are very strong with the share price decreasing, giving us an incredible opportunity to add this company to the portfolio. And we can see here an equity strategy analyst saying that they are buying lots of more shares of UNH and essentially taking advantage of this dip. Now, we can't talk about this company without briefly mentioning one of the reasons why over the shorter term it has been down. And we can see, and as we've highlighted, insurance stocks across the board have come down since Brian Thompson, the CEO, was killed. Now, we're not going to talk too much about this. It was a very horrific event, but we have noticed across the board, as we've shown, this has impacted the market and in particular the healthcare stocks. In terms of UNH, that is what our attention is in today's episode. Over the last 10 years, if you do want to zoom out, it has performed very strongly, outperforming the S&P up 407%. If you reinvested dividends, you would be up slightly higher. And as we can see, trading in the mid to lower end of the 52-week range with a forward yield of 1.6% and a forward P of 19.3, that is trading below the S&P 500 as a whole. Now, as we mentioned, UNH isn't the only company affected. Whilst we won't cover Elevance Health, this is one that is down 28% in the same sector, trading at its 52-week low, looking undervalued, although you can check out our deeper analysis on the channel. We have CNC, a very similar situation, down 14% over the last few months, trading at its 52-week lows, as well as Molina Health down towards its 52-week lows, and just in the more recent period alone, down 7%. As we've said though, UNH is the episode talking point, and one thing we do have to highlight, in their more recent quarter, essentially their forecast for 2025 wasn't what Wall Street wanted to see. It was below the street estimates, and that was one reason, if you do go back to a few months, why the share price did start to fall. And as we've just mentioned, the CEO killing has essentially propelled that to continue moving further south, right now trading at under $520. If we look at this company in terms of their earnings, one thing we'd love to see is green right across the board. That is what we get with UnitedHealth. This translates to the next 4 quarters all being growth to the EPS on a year-on-year comparative, and over the last 4 quarters they have outperformed what analysts have wanted to see, giving them a 100% historical forecasting accuracy. Now, you will have noticed in Q3 they did have that beat, but remember, if companies are not increasing their guidance at a bare minimum in line with the street estimate, they will be punished, and UNH is just another example amongst a large list. In terms of the EPS, well, they are anticipating just under $30 per share. That in turn will lower the forward P to 17.83. And one thing we really want to draw to your attention are the fundamentals, which we do believe to be fairly strong for UNH. First thing we'll point out, dividend safety score 99, that is the highest score obtainable at very safe. An undervaluation signal on dividend yield theory, an undervaluation signal that we'll mention later on, and we can see they have increased that dividend at a double-digit rate in June this year. Now, what does a dividend safety score of 99 mean? Well, first things first, this was reaffirmed at the end of October this year, and we can see it essentially translates to a dividend cut being highly unlikely. Now, how did they perform in the last recession, 07-09? Well, they maintained the dividend, didn't increase it, didn't cut it. They had plus 5% sales. Remember, that is above the average of the S&P that sits at negative 12. And they also marginally trailed the S&P, negative 63% in terms of total return. S&P itself, negative 55. One thing we like about this company is the consistency in those dividend increases. In fact, over the last 20 years, if you've been a shareholder, not only outperforming the S&P 500, but also those dividends have increased at a rate of 41% year on year. And we can see 14 years of consecutive increases with, in fact, 31 years of paying a dividend without a reduction. Now we get to the first valuation model based on the 5-year average P ratio, but remember, we're not looking at any one of these models in isolation. We will conclude towards the end when we put it through our own models. Now the blue tunnel signifies the fair price, and we can see right now, for only probably the second or third time in 2024, it is outside, indicating severe undervaluation. And when we look at dividend yield theory, which remember tells us a company is undervalued when the current yield sits above the 5-year average, we get that undervaluation signal here, and in fact a triple undervaluation signal with the forward PE 17.9 below the 5-year rolling of 20.1, although we do have to point out it is trading at a marginal premium to the overall sector. Does it deserve a premium? Again, we will compare that against the sector median metrics later on. As always on this channel, we always draw your attention to the free cash flow, earnings susceptible to manipulation by management through accounting. Below 60% is what we want to see. Look at this, below 30% every single year, and over the next 12 months anticipated to be the same, telling us that we do anticipate another double-digit increase in June next year to the dividend. We then move on to the free cash flow per share, where we want consistent increases over the longer term. Something we actually get with this company, fairly rare, we don't see it all the time, and that is expected to continue over the next 12 months to $32 per share. In terms of sales growth, 3 to 4% at a bare minimum, just to keep up in line with inflation. Looking very strong for the large part, double-digit growth, and that is what we get over the last 3 years, which in turn, when we look at these sales from a numerical perspective, we can nearly see 3 times growth over the last 10 years. Now, whilst we like to look at shares outstanding because it tells us whether or not companies return excess cash to investor pockets through those share buybacks, we notice with UNH, a little bit inconsistent over the longer term. Some years they do share buybacks, some years a little bit of share issuances, but overall they have bought back a fairly trivial amount over the last 10. We then move on to ROIC, 10% or more. Give us faith, management are able to effectively allocate their capital, and we get that on a consistent basis year on year. In fact, pretty much 19% over the last 10. And remember, on this channel, sometimes we do add a little bit of a premium for companies that do have some very large consistencies in positive metrics. Then move on to the operating margin. Now, typically this wouldn't be great because it's not above the minimum 12%, but we also have to understand for the industry, this is actually pretty decent, fairly strong, around the 8 to 9% mark. So it isn't one that we would have a worry with, although typically, yes, we want to see it above the minimum threshold. Free cash flow margin, pretty much straddling around the 5 to 6% year on year. And then we move on to the final metric that we're going to analyze here, the net debt to EBITDA. That references the earnings before the interest, tax, depreciation, amortization. And below 3 is what we want to see. Remember, this correlates to dividend safety, balance sheet strength, and also these are the number of years it would take the company to pay off all of their debt net of cash on hand, sitting at 1.09 on a trailing 12 month, anticipated to go lower over the next 12, just highlighting they have a very strong balance sheet, and that dividend, as we saw above, is secure, 99 score. Now, we also want to point out we have just released our latest free weekly article where we highlight one stock we are buying heavily in the month of December, and you can always grab a copy by clicking on the pinned comment below, signing up, reading straight away. We ultimately send one copy to your inbox every Monday morning where we highlight companies that are severely undervalued, deserving your attention, and also updates to what's happened in the market over the last few days. And as always, you can grab a copy of 28 undervalued dividend stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of 29 dividend stocks with massive upside. In fact, these are stocks that Wall Street themselves believe over the next year have the most upside in the S&P 500. So click below, you can sign up and start reading straight away. We then move on to insider ownership at 0.33% with around 3.5 million worth of sales over the last 12 months. However, in the more recent quarter, we have no buying, no selling, and in Q3 we get the selling at 2.49 million. Now we'll show you for transparency who these are. In fact, the most recent one, the 18th of July, the EVP selling 1,500 shares, netting them around $900,000. Full transparency is here, but as we say, insider selling, not what we consider a bearish signal. They sell for many reasons, personal and financial. In terms of the institutional aspect, 88% ownership, 24 billion worth of sales over the last year, with more buying during the same time frame at 33 billion. And when we do look at the most recent quarter, Q3, we actually get double the amount of buyers and sales. So institutions clearly bullish on UNH, but as always, do your own due diligence, never copy blindly what institutions insiders buy and sell. Then we're going to highlight the income statement. Now, yes, we've already showed you their top line revenue growth, which has nearly tripled over the last 10 years. But what we really want to factor in here is their bottom line net income, something we haven't covered. Does it give us a very similar story to the top line? And the answer is yes. This is something we love to see. With revenues growing, you would anticipate bottom line would also grow in the same format, but you would be very surprised at the number of companies that does not apply to. So nice to tick that off with UnitedHealth. We then move on to the balance sheet. As we've already said, quick total cash versus total debt to analyze the health of the company. Now, cash over the longer term has in fact increased, and quite significantly, from 7.5 billion in 2014 to 32 in the latest quarter. As always, one number here in the balance sheet will not tell you anything, which is why we compare it numerically and directionally to their total debt, which, as we have seen here, has also increased over the longer term, going from 17 billion to 78 in the latest quarter. Quite a large jump, but as we saw on the net debt to EBITDA sitting around 1, meaning it take them about that 1 year to pay off all of their debt, net of cash on hand. No worries, but as always, something we can keep our eye on. The other thing we want to analyze very quickly is the cash that they do generate from operations. And again, similar to every metric, this company does give us quite a lot of consistency, and again, not something we should take for granted, as we don't see that across many companies. 8 billion in 2014, 29 in the latest annual accounts. Now let's move on to some gradings. The first one is the valuation at a D-. Now P on a non-GAAP basis at around 19.3. That is marginally lower than the sector at 21. So if you're buying this company right now based on this valuation metric, you are getting an 8% discount, and you can see that across nearly every single valuation metric, although some of them do show a slight difference, so it will depend on which one you like to use in your own thesis. But remember, sometimes companies deserve to trade at a discount, sometimes companies deserve to trade at a premium. These are questions we always need to consider. In terms of growth, B-. Revenue year on year, 9.4, sector 7.4. Moving forwards, 10.4, a little bit higher than the sector median. One thing we do like to highlight though here is their earnings per share is anticipated to grow at 15% year on year over the next 3 to 5 years, a lot better than the 10.9 from the sector comparison. Finally, we get to the profitability grade where they get an A+, gross margin then 23%, a lot lower than the sector at 58. However, one thing that we do like is their bottom line margin at 3.6, a lot better than companies that are just losing money with a net loss or net margin, in fact, of negative 4.4. And the one thing we already highlighted where they do get an A+, cash generated from operations over the last 12 months, 16.6 billion, the essential sector median burning through cash, negative 15 million. So quick recap here for this part of the analysis: strong buy from Wall Street, buy from Seeking Alpha, and a hold from Quant. D- on valuation, B- on growth, with an A+ on profitability. Now, two more things before we go to our valuation, and the first one here is the comparison of their performance against others in the similar sector. Quite a lot of these, as we did say at the beginning of the episode, have had some very difficult times over the last few months. Now, total return, including dividends reinvested, UNH is down 3.3%, and this is where we typically ask ourselves, is this an isolated event? Is this something that affects only UNH? But no, look, the majority, in fact, every single one of them, bar HQY, has been down over the last year, so this is something that is sector-wide. Over the last 5 years, in comparison, we can see UNH, one of the better performing, up 99%. And over the last year, we can see the best performing up 488. Remember though, past performance, absolutely no indication of the future. They could perform better, they could also perform worse. And as always, before we get to the valuation, we must highlight the comparison against the S&P. Now, they've massively underperformed over the last 12 months. Over the last 5 years, they have marginally outperformed. Over the last 10 years, massive outperformance. Question is, can they continue to outperform, or should you actually move towards buying a low-cost ETF that does track the S&P? Now let's jump into the valuation model, where our intrinsic value sits at $594, and that is the average of these three models that you can see on screen. Now when we get through the first model, we have the multiples valuation. Remember, we're not looking at any one of these models in pure isolation. We have those companies in a similar sector and size, their average P multiplied by the EPS of UNH to give us our first signal, which is overvaluation. We then move on to the dividend discount model, very nice increases over the period, on average 14%. We've got a lot more conservative, giving us our first undervaluation signal. And then we move to the DCF model, free cash flow year on year, average growth 17%. We have gone a lot more conservative, even more than analysts at 7. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, our second undervaluation signal, giving us the average today at just under $600. Now remember, on this channel, we always apply an MOS at 10%, execute on that if it meets our 3 golden criteria, a wide moat, strong financial metrics, good forward-looking data. Look, if you believe that in today's episode, a buy at $534, then we keep going till it's near the current trading price. And what we do find is for a 15% MOS, it would be a buy at around 505. So right now, you're getting somewhere between 10 to 15%. Now, as I mentioned at the beginning of the episode, this is one that I do hold in my own portfolio. And at the 15% MOS, I probably would like to see a larger figure for adding somewhere around the 20% level at 475. And that is something we have seen over the last year. In fact, its 52-week low was $436. It may get there, it may not, but for me, at around 20% MOS at 475 is somewhere that I would add today. Right now, though, it is just analyzing this position where it sits between 10 to 15% MOS. In terms of Wall Street, their price target is $625, where they see upside of 20% over the next year. Right now, though, 10 to 15% MOS, 20% upside. Is this one you are looking to buy? Maybe one that doesn't interest you for whatever reason, do let us know. Or in fact, one you are going to wait for it to dip lower, if it does, to consider in your portfolio. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, and also come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.